Okay, Q&A time for the last market outlook. I have scanned through some of the questions, and I'll tell you right now, for many of them, I don't know. I don't know the answer. When you ask me about specific stocks or specific markets outside the US, my answer is typically I don't know. If I've never heard of the stock, it's just simply I don't know. First one, I don't know. What do you think about selling puts on PANW, the recent Pelosi purchase? I don't know, but I would seem to think that if you're just not doing your homework and outsourcing your thinking to someone else, especially a politician who went long a stock and thinking that maybe they know something, you're going to sell puts. That's a lot of lazy thinking and a lot of shortcuts in there. That if it turns around and bites you, don't be surprised. But I know nothing about the stock. I don't even know what that ticker is for. Wondering if you can add another video to portfolio construction and management. Like to see is going in depth into setting up the income factory. Maybe the AT&T mentioned in the previous videos. I have done an income factory, and it's really easy. Just sell a put. Sell a put at 17, 30 to 45 days to expiration, and wait. And then sell another put. Just keep selling puts. You know, what does it say on the shampoo bottle? Rinse and repeat. There you go. That's really all it is. The work in setting up an income factory is not in the process of it. Is not in setting up the puts and then determining when to switch to calls or when to add calls. The real work is finding the underlying to do it with. You'll go through probably 50, 60 stocks before you find one that makes sense. AT&T makes sense. T-Mobile doesn't make sense, and Verizon doesn't make sense, but AT&T does. That's the hard part. The easy part is, what do? Sell a put, wait. Then sell another put, wait. Then sell another put, wait. That's all that's involved. If it gets put to you, well, you got a 6.5% dividend yield, right? And what you can do is then sell the 17 call while you're selling the 17 put. You're going to be right on one and wrong on the other. And if it gets called away from you, well, then when it got put to you, you probably got it for an average of 16.50, and when it gets called away from you, you probably got an average of 17.50, and if you held it for a while, you got a 6.5% dividend yield. So the operation of it is pretty straightforward. Most of your time will be spent in finding the appropriate underlying to do it on. What was the decision-making process choosing INDA over iShares Nifty 50? I picked one. I simply picked one. I know nothing about the Indian market or nothing about the stocks in the Indian market at all. It is a macro play. So as far as me breaking down which benchmark to use by the constituents in the benchmark, I know nothing about any of the stocks. I'll just tell you that straight out. The play is a macro play. That's all it is. In the macro play, you want to pick a broad-based market index. And you want to try to avoid all the specialty indexes, because now you're making a play specifically on the Indian, specific things to India. I know nothing about it, but from a macro perspective it works, so I just picked one. I keep getting assigned with TLT, trying to sell deep in the money puts. Well, that's why you're getting assigned. You're selling the deep in the money puts. But what you can do is you just close them out before you get assigned. Roll them forward. If TLT has risen from the time you sold the put, you should have had some profit in the put. If you don't want to get assigned, try selling out of the money. 93 puts, 94 puts. I was wondering other strategies I can employ for a leveraged bet on TLT. Just use out of the money puts. As for the ZQ December futures, how will margin work? I think margin there is around, it's really low. Like really low. I don't know what the margin was, but it is really low. I know the contract size is over 300K, but BKR still seems to let me buy it. The contract size, that's just the notional amount of the underlying. I think it's bigger than 300K. But the margin, I think, is either like $1,000 or $2,000, it's really low. Additionally, is there a reason to be long the December futures rather than option on ZQ? Well, if you're long the option, you first have to have the index rise to cover off the cost of what you paid for the call, and then you start making money. Whereas if you're just long ZQ, I don't know why you would want to use options on ZQ. They're going to be illiquid most likely, and the underlying would have to rise to the point of break even to begin with. Any thoughts on getting another dog? Not yet. At some point, probably, but not yet. Depending on your source for CCC spreads, there are two components to the spread movement. Companies are so distressed that the spreads move with fundamental news, or liquidity in the double C spreads and lower so significantly limited compared to the higher rated notes. Well, I'm using COIFIN for it. You can even use FRED for it. You get the same spread. In CCC, it's not just one that you're looking at. It's a family, like it's a whole group, or an index you would call it for CCC. But it tends to move with everything else. But last week, it is the only one where spreads tightened, but all other higher quality spreads widened. That's why I said this seems rather odd. Are interest rate futures such as ZQ and SOFR 3 priced based on market sentiment? That's correct. There is no carry. So when you look at it, it's the market pricing in something. There is no carry on it. Correct. Our interest rate, we did that. I was just wondering, what is your opinion of U.S. small cap? I think they're challenged. I think in a high interest rate environment, they're probably more challenged than large cap in maintaining a low cost of capital. The disparity in valuation with large cap is the largest we've seen, and we know that they are more rate sensitive given their higher debt proportion on their balance sheet. So they should be first to enjoy a rate cut. Yeah, I think once rates start being cut, small caps would probably start to perform a little bit better. So if you're looking at the interest rate sensitivity of stocks on rate cuts, if you're thinking that the U.S. small caps should be more interest rate sensitive than large caps, that their price should move up by a greater percentage, that small caps would outperform the large cap in a rate cut cycle. Yeah, I think that would be a safe bet to make. You were considering moving to Florida at one point. I was. If you aren't a U.S. citizen, how would you be able to live there year-round, be able to register as a resident for tax purposes? I can get U.S. citizenship. I have a U.S. PhD, which puts me front of the line. Not only that, I have significant wealth. Combine U.S. PhD with significant wealth, you are front of the line for a green card. So it wouldn't be difficult for me. It's a point system, and the points that I would score are way above what's needed, easily way above what's needed. I'm wondering, as in my experience, this isn't a possibility for non-U.S. citizens. Not for the average person, no. That you have to have something that the U.S. desires, and that is either a high level of education or a high level of wealth. And if you have both, yeah, the U.S. will say, yeah, sure, hang out here with your education and your wealth. That's why the U.S. is the largest economy on the planet and controls most of the wealth in the world, even though it's like 5% of the population, but controls 50% of the wealth, because they prioritize that front of the line. Feel free to skip this question. All right. If agencies' financial statements says they are net long TBA and forward settling securities, I know this is achieved through a dollar roll. I'm not sure side of the transaction they are on if they are net long. So think about it as like a calendar spread. If you have a long calendar spread, you are short and then long. The modifier refers to the later leg. So think about it in terms of the dollar roll. The underlying is $1 million of securities, and it is how many securities or how many bonds you have to deliver to equal $1 million. So you're short $1 million and you're long $1 million. Well, what are you doing here? You're selling and then you're buying. What is that? That is a short position, right? Think if you had stocks. If you have stocks, you sell and then you buy. You're hoping the price goes down. So when interest rates are rising and spreads are increasing, selling and then buying $1 million, what you're doing is saying, I'll give you $1 million of securities, you return $1 million of securities, but you may get more bonds for that million. So you're really just shorting when you're net long. If we expect interest rates to drop and spreads to widen, you would want to be net short at that point instead of long. In other words, you would buy, whoops, I got rid of all that. You would buy, well, let me see if I can get it back. No, I can't. You would buy and then you would sell. So you'd buy $1 million and then you'd sell $1 million, and when you sell, you're hoping that you sell fewer bonds when you sell than when you buy, basically getting bonds for free. Sorry about all the beeping over here. I don't know what's going on. Oh, the JOLTS report was just released. That's what's going on as I'm writing this. I have the my iPad open because I wanted to see what happened with Bank of Canada. Bank of Canada on hold. Bank of Canada on hold. And the JOLTS report just came out. That's why I got all that beeping going on. So yeah, that's what's going on. It's because of the nature of the contract. It's for a certain dollar amount, not for a certain number of bonds. So if I buy $1 million worth of bonds and I agree to sell $1 million worth of bonds, and the $1 million worth of bonds goes to $1,050,000, when I sell the $1 million worth of bonds, I get $50,000 of bonds for free, just on the roll, right? So it would turn into a net short, I think. Operationally, how does agency short U.S. Treasuries? It simply just sells. So it'll find ZN and it'll just sell, and it'll be short the contract. You can do it yourself. You just have to sell the futures contract. Lesson on R-star. I don't know that you can calculate R-star. You can have models that attempt to get at R-star, but they can be quite complex. New York Fed updated one of the models last week. Oh, well, there you go. And it's a lot to try to understand. Any comments would be appreciated. Love your content, and thanks for sharing. And it probably has like 49 variables in there, right? With the yield curve probably being a very big one. I've gone through one of those models before. They can be complex, especially when you have one variable for every key rate, and then you have a variable for every lag as well if you're doing time series, and every key rate has its lag in there as well, and then you have a vector of, let's say, macro variables as well. It can get very complex. I don't know, other than if you were an academic, I don't know that it would be very practical at all to come up with an academic guess as to where R star is. I don't know that it would be useful in the least. I'm curious to know what kind of options play you see there. Sell puts. I would say sell puts. IV rank is relatively low. I don't like rank. I like IVP, the percentile. Selling puts even at the money must not yield much. Not really, but 1%. 1% over like a 35-day period. There isn't much in there, but you know, you're looking for the best play you can. I think that having a long exposure to India makes sense. So you can either buy at $96 or what was it, $94, or you can sell a put, hope to make a buck. If it gets put to you, that means you bought it $1 lower than you would have bought it had you bought it at the market. That's all it's doing. I like to build positions by selling puts first. That's just the way that I like to do it. Consider doing narrating review videos for the CFA levels. I know you stepped away from the longer videos. No, I do the longer, the reading videos. I just don't do the review videos. Love if you had a review summary breakthrough. So CFAI over the years has reduced the number of words that it uses and increased the number of examples, that if you were trying to summarize the very few words that exist now, your video would be just as long as the main video. That with so few words, review videos just sort of lost their allure. Not only that, there was always the danger of somebody subscribing late and just cycling through the review videos without really learning anything, because the review videos when I did them, took no time to teach anything to you. It simply just reviewed. It was just a review video. I don't know that they would have value now that CFAI has gone to the module approach, such that 2 readings are now 8 modules, and each module is so short. I just don't know where the value would be. That doesn't mean that there isn't a space for them somewhere. It's just, it would have to be somebody else's responsibility at this point. What forward multiple are you seeing for Nvidia? Well, it depends on the growth rate that you're using quarter over quarter, right? So if you used, they had previously something like an 18% growth rate quarter over quarter is what they were forecasting, so I used that. But they came in, their earnings this time came in at a 24% quarter over quarter growth rate. So if you say, well, let's go conservative, we won't go to 18, we won't go to 24, but if you use 20% quarter over quarter over the course of the year, that is quite a bit. But if you use even if you use a $20 earnings at $860 or $850, $900, somewhere in there, 8 times 540, you'd be at 45 times forward earnings. But if you're growing at 20% quarter over quarter, that's a growth rate of 100% a year. So if your forward multiple is 47, even 50, let's say they have a forward multiple of 50 and you're growing at 100% a year, let's even be conservative and say you can only grow at 50% a year, not 100%. That's a PEG ratio of 1. That is called growth at a reasonable price. In other words, given their growth, Nvidia is at a reasonable price. However, if you think that this is an infrastructure build out that will be over in 6 quarters or 8 quarters, where anybody who wanted something has something, and then that growth rate drops down to more like 10% year over year, then yeah, they're massively overvalued now. But if you think this is an ASML story, ASML sells lithography machines. They have competition, but ASML is so far ahead of the competition that even after the competition says, aha, we have 3 nanometer, ASML has 2 nanometer. ASML basically has a monopoly in lithography machines, even though they have competition. Do you think that Nvidia could be the same thing? That Nvidia's chips are in the position of ASML's lithography machines, that even though Nvidia could get competition, that they will always still be ahead of the competition, and everyone's just going to want the Nvidia chips even if there is competition? Then it could be, a 6-7 year, maybe a decade long growth rate at these numbers. That's the question. Is this an infrastructure build out that's going to end in 6 to 8 quarters? In which case Nvidia is massively overvalued right now. Or do you think this is a decade-long thing and they are sitting on an ASML-like position in GPUs, in which case they're priced reasonably? So it really depends on what you think. Bank term funding sunsets 311. Okay. What did I say in the video? I forget. But okay, March 11th. How would you structure an allocation factory on EWW and INDA? Well, you sell puts. You determine how many shares you want, then you start selling puts. INDA doesn't have weekly options, which makes it hard to get an allocation factory on INDA. For allocation factories, you really do want weekly or at least bi-weekly options. Weekly is the better one. And then every week you sell a 2-week option. Every single week you sell 2-week puts. And then when your allocation gets to a certain size, you start combining your puts with 10 delta or 15 delta calls. INDA doesn't have the frequency of the options, it would be a little bit harder. Probably not worth it to do allocation. You probably just keep selling puts till you got the allocation you want. Any thoughts on Mexico? Still like Mexico? Do you think the currency has still room to run? Yes, I do. Yes, I do. You plan to do a video for Fed balance sheet in the applied series? I am, but I do have to get to the new level 3 stuff. So usually from mid-August to mid-February, mid-March, I do the applied level, and then I have to jump over to the CFA stuff because I still have obligations there. But this is something I could probably get done concurrently. How do you think about TLT and the overall price where you feel comfortable, and do you get anchored to a price? Well, I feel comfortable with 93 puts. I feel very comfortable at that. I don't know that I'm anchored to that price more than I'm anchored to the Fed and 3 cuts. I think it's more than 3, but we'll use 3. I don't know that I anchored to the price. I personally feel like I have a good understanding about what shifts the curve upwards, downwards, but I'm unable to conceptualize why the 20-year should be yielding 4.4 as opposed to 5.3, 6.5, etc. Well, why do you think? So I don't know your thinking and why you think it should be 5.3 or 6.5 instead of 4.4. So I almost have to fill in the gaps of, or come up with reasons why it should be, and I don't know. I guess, when I see something like that is, well, why do you think it should be that, as opposed to me trying to figure out what would be the reason why it would be that. How do investors justify the current yield? If that's where the yield is, that's where the market is. I don't know that I have to justify it. That's where the market is comfortable. There are all kinds of different buyers in a market who may not be you, obviously. And you may say, I don't like that yield. Well, then you're not a buyer, right? You're just not in this market. And that just happens to be where the market happens to be. It's like saying, how do you justify a multiple of 22 on T-Mobile and a multiple of 11 on AT&T? Well, that's where the market is. This is just where the market happens to be. I don't know how they justify it because I don't know who they are. Who is buying, who's the holder, how far they think it should go up or down. Well, you're making an assumption that the buyers of the securities are looking for the capital gain and that they're not just comfortable with the yield. So if I'm a life insurance company and I sell a whole bunch of annuities and I can hedge out all my annuity costs with the 20-year, I'm done. I'm not in it for the gain. I'm in it for the transformation of the yield, which will happen over 20 years into a shorter term stream of payments called an annuity. So that could be the buyer. But it's to say how do buyers justify this price? It's sometimes there is no justification. How do you justify the price of stocks in the S&P 500? Well, you have a lot of index funds that simply have to buy the components of the index no matter what the price is. They're not trying to justify it. That's not their motivation. I don't know that I would look for a justification for why a market is where it is if you disagree with it. It just could be that's where it is because for those transacting at the market, it is what they need it to be. When you have a portfolio of stocks that belong to 2 indexes, how do you know which index to use as a benchmark? The more broader index, if I had to just guess, I'd say the more broader index, as opposed to the more specialty index. If you own Apple, Amazon, Google, should you use QQQ or S&P? Depends on what else you buy. It depends on do you have others that are more NASDAQ-y? or others that are more New York Stock Exchange. The more NASDAQ-y you are, the more you'd want to use QQQ, I think. India defense companies are a good bet. It's expensive, but lots of scope with many countries interested. Fred, Q4 23, quarter over quarter in median sales price of houses. I think you're leaving out some words here. Median sale price of new homes, existing homes. And that's just a median sales price. That is affected by the type of homes that are being sold. So if you have a market where more high-priced homes are being sold, even if those homes are selling below what they originally were purchased for, the median sales price will look like it's higher. And if you have more lower-priced homes that are selling, the median home sale price will appear to be lower. So I don't know that is so much again, are we talking about new homes or existing homes, or all homes? Surprise drop considering supply constraints or reasonable downside deviation on a greater trend? I think probably wrong price series to look at. You'd want to look at a price series which looks at, that is transactions based, as opposed to the median home sales price, which doesn't consider the previous transaction. It only considers that one transaction. I have SPY position where I have short calls, but my strike is currently well below where SPY is trading, so it's in the money. Options will expire in June. Do you see any disadvantage of rolling them up and forward? As long as I at least get $1 credit rather than waiting on the last day of the expiration. I'm afraid of getting signed sooner, as those short calls are well in the money. But I don't know that it would matter. You can roll them forward. If you roll them forward and up and you're receiving money, that's still good. That is still good. You can do that to the extent that you receive money, but once you got to start paying for them, then you're booking losses right away. So you can try to do that, sure. Can you explain currency appreciation point in more detail? For some reason, I'm having trouble understanding this concept. Well, okay, it's very, very simple. If you buy stock ABC, what do you hope is going to happen? You hope it goes up. That's it. Anything that you're long, any position that you're long, you hope the price goes up. When you buy a foreign stock, you're buying a structured product. The structured product, we'll draw a circle, has two things inside. You are long the stock, and you are long the currency. So what are you hoping when you're long? You're hoping the price of the stock goes up and that the currency strengthens, because you're long the currency. Anything you're long, you want the price going up. That's all that is. It's very, very simple. If the value of the Indian rupee increased relative to the US, how does that impact the investment? Because you have an index, you have INDA that owns a bunch of stocks denominated in rupees. However, it reports its price in US dollars. So if all the stocks stayed the same and the rupee strengthened in value, the US dollar version of it would also strengthen in value. That's all that is. It's because you are long the stock and you're long the currency. Both of these things will benefit you. Looking at emerging markets, curious to get your thoughts on investing in Latin America, Brazil and Mexico. I don't know anything about Brazil. Mexico, yeah, I think has value. Valuations are incredibly attractive, particularly in Brazil. I'm going to just take your word on it because I don't know. Share with us a source from which you get your data in the OS table. You can use Koifin, which really just pulls it from Fred, right? Or you could just go to Fred directly and you can look up each of the OASs on your own. If we are bullish on a stock, and we want to take a directional long call position, which one of these two positions brings the highest return? Buying expensive in the money calls or buying cheaper out of the money calls, but in higher quantities for the same total. I don't know. I don't know. Um, this has so many more questions to ask. Which one of these brings the highest return? Well, first of all, I think you mean the highest expected return. The highest return you'll only know after it's over. The highest expected return. Um, I don't know. Yeah, I need to know the shape of the implied volatility curve. I mean, what if it looked like this, right? What if it looked like that? And you got at the money, and then you have your calls, which have much higher implied volatility. I'd have to know a lot more. There is no one answer to that. It would, if you have low implied volatility, you have to think about the probability that the stock would even get to your strike price for out of the money. So it's, yeah, that's a question that doesn't have an answer without a lot more information. Aussie dollar did not perform on the back of the Chinese economic expansion. Yeah, it did. It did incredibly. In the early years of the Chinese infrastructure build-out, the Aussie dollar performed extremely well. It traded above par with the U.S. dollar. It got to, I think, $1.08, $1.09. Where is it now? Low 70s, high 60s. But it did perform well in the early stage of the commodity supercycle. It did not perform well in the second stage of the commodity supercycle. So commodity supercycles are big, long supercycles, which are about 30 years. About 30 years, where you have build out and then you have excess capacity. Each cycle being about 15 years, and the last supercycle peaked about 2008, 2009. So add 15 onto that, because you have 15 bear market, 15-year bull market. You get to 2023, 2024, but you need a catalyst for that, which means you need a major infrastructure build out somewhere. Well, this was China, this is India. So you're looking at the Aussie dollar in the downswing of the commodity supercycle. In the upswing of the commodity supercycle, it did very, very well. Well, this is where we'd expect that the supercycle would bottom somewhere around there and build up. You need infrastructure build-outs. You have India. You have smaller countries like Mexico. You also have utility build-outs as well. You also have move to EV from traditional vehicles. You have a lot of reasons why materials are going to be in demand over the next 15 years. And so you are at the beginning of another commodity supercycle. So the Aussie dollar will do very well in that respect. Perhaps a pure Aussie material. Yeah, I could see that as well. A while ago you talked about wheat futures and selling 800 puts on them. I wonder what you think about wheat lately. I haven't looked. Have you changed your opinion after nice weather and good planting season? Well, I don't know. I haven't looked. But if that was the case, I would have changed my mind as conditions changed, yeah. Wouldn't the cross play be ideal for INDA and three largest stocks on the ETF to offset the NER? The MER, the management expense ratio? Well, I don't know what you mean by cross risk for INDA and three largest. I don't know what you mean on that. How does the 10-year play? How does the 10-year play for India unfold in the event of a 2-year drop driven? That's such a specific question. How does the 10-year play for India on do you mean the 10-year time horizon or the 10-year yield? Play for India in the event of a 2-year drop. A drop in the 2-year yield or a 2-year drop in prices driven by global. If you mean what does the next 10 years for India look like if the next 2 years are bearish, well then it's bearish. I mean, it's not like it'll escape the gravity of a global sell-off, it'll suffer the same thing. But we're always one thought away from a 2-year sell-off, from a global equity sell-off. Is, well, what if things sell off? Yeah, that's the risk. That's the risk. What if I buy a house and it burns down? Yeah, that's the risk. What if I drive a car and I get in an accident? Yeah, that's the risk. But we can't just sit in a safety room with our money in a bag on the floor just because we can think of a risk. That's a risk. But you could wait 5 years for a global equity sell-off, right? I don't know that it behooves you to sit on cash waiting for a global equity sell-off. Be invested, and if a global equity sell-off happens, then you engage in risk management. Then you start bringing in things like lowering your beta to zero without actually selling any stocks by shorting futures. I think that would be a better approach than sitting somewhere waiting for the global equity sell-off. If the Fed is going to reduce their holdings of MBS, what could be the impact on the residential real estate sector and REITs? I don't think any. Only because MBS issuance has been so low for the last 2 years. I don't know that there'd be much of an effect that you would feel. But it depends on how they get it to zero. Right now, the runoff per month is so low that I don't think it has any effect. What do you think about gold? I'm not a gold bug. I've never been a gold bug. I have no opinion on gold. How do you explain gold's increase along with the stock market rally? I don't. We did the OAS, so we can pass on the OAS. Oh, hang on. Maybe the OAS. The reason is because high yield, we're already too high in spreads as of the 29th. That doesn't answer the question though. All the spreads were super tight, and all of them widened, and even CCC was super tight, and it contracted yet even more. So that doesn't answer the anomaly. Why should we care about AUM for an ETF for liquidity? Because the more assets under management, the more trading you're going to get per day. If there's only 10 people in an ETF, then how much trading you get in a day. But if there are 10,000 people in the ETF, well, then you're going to get trading every day. You're going to have more liquidity. It's not the creation redemption process that ensures liquidity. The creation redemption process ensures that the NAV of the ETF stays very close to the NAV of to the value of the underlying. That's what it's for, but it doesn't ensure liquidity, because the transaction that goes on with the sponsor and the authorized participant is with each other, not with the market. We had a large drop in 10-year yield on Friday, but TLT did not rise significantly. And TLT is 25-year bonds, not 10-year. When you decide to give up defending a position with options, when do you decide? When the stock goes against you, especially if it has been a couple of months. Well, I guess if the fundamental story of the stock is broken, what were you doing with the stock to begin with? And if that story no longer exists, then you give up, but if it's just other forces at play, but the story is still in play, depending on, there is no answer for some of these questions, right? One of the things you have to understand when it comes to the market, it's a lot of if this, if that, then maybe. There's no if this, then that. It is if this, maybe that, maybe the other thing. But if it's this and that other thing, maybe none of those, maybe it's something else altogether. There is no algorithm that you could program saying if this, then that. If there is, we would not be here. None of us would be here. Everything would be run by algorithms. There'd be no finance courses. There'd be computer science courses. Finance would be taught in computer science. Nobody knows what's going to happen. it's everybody's best guess as to what's going to happen. So to say how long do you hold, I don't know. You tell me, give me a specific case, a real case, and I'll tell you what I would do in that case. But hypothetically, I'd have 20 more questions as to, well, tell me what's going on first. Tell me what's going on. Is the market going down? Is the sector going down? Is there something wrong with the company? Is it an event? Is it a trend? There'd be so many questions that there are no one-shot answers to these types of questions. INR, both the float and the rate, is kind of influenced by the Indian government. What currency isn't? What rates aren't? And they really want to keep their INR weak to increase exports and boost up manufacturing exports. So if you can read into that and probably not bet on INR strengthening, it wouldn't matter what they're trying to do. It wouldn't matter at all if money is going into the country and it has to buy the INR. There really is no choice. The INR is going to have strength. There is, you can say I want a weak currency, but the market will be what the market will be. So unless they actually get out there and manipulate the currency, unless they're actually doing that, or pegging the currency, where every day they release the peg and they say, like China does. China pegs the currency and that's it. It's difficult to bet on the direction of the currency from foreign direct investment or cash flows. You have to predict the direction of the currency from the Communist Party's willingness to do something. So it wouldn't matter what kind of currency a country wants. The market's going to make it whatever it's going to be. And if money's flowing into the country, there is no choice. It's going to strengthen. I was thinking of dump of agency MBS by the treasurers. Roughly 15 billion per week. Can you analyze the impact on ABR? And it doesn't affect ABR at all. And as far as agency, 15 billion is too small. No impact. It won't affect ABR at all. ABR doesn't hold MBS. Can you point out what does the current good situation can be maintained next to point out what does the current good situation? I don't know what that means. I don't know what current good situation you're referring to. How to manage a short straddle when the market moves in your favor or against you? I don't know. You tell me what happened. And here it's another one of these things. It's moving against you. Why is it moving against you? How long has it moved against you? How far dated are your options? What are your alternatives? What was the reason for the short straddle to begin with? There is no answer. There is no one answer to that. There are potentially 50 answers to that question depending on the setup, right? Here's what I did, and I'm reflecting if I did anything wrong. Entered into an at-the-money short straddle at market close. Next day, the underlying went up beyond the premium, so the position is at a loss. Seeing the put quickly depreciate, I covered it at a low price. The call was, however, still open. I was hoping for an adjustment, and maybe some if I could cover. Okay, well, so when that happens, you close the the short put. You have made some money on the short put. Whatever money you've made, you look to buy a call with that to hit your break even. And then you have a call spread, and that would give you a defined risk, which means no matter how far up Nvidia goes, you're done losing. You've locked in some hopefully some smaller loss than if you just took the loss right then and there. You've locked in some smaller loss. But sometimes you make a play and the end result is it's a loss. That there is no getting out. That's why when I talked about the short straddle, I was very clear. I'm not doing this. I said, I think it pays, but I'm not doing this because it was just a gamble. I think what messed it up was the pullback before the earnings. If it was done at the 7:30, the short straddle would have paid because there was 100 in premium in there. It would have paid the next day. Not much, but it would have paid the next day. But I wasn't going to do it. So yeah, you take your profit on one and you use those profits to buy the most expensive call you can for that profit, and you create a spread and you live with the spread. That is your defined loss at that point. Or you know, it would be a loss that would be less than if you closed all the positions right then and there. Recently read there are generally less sellers of equity puts than buyers of equity puts because the world is continually long. Well, it's a contract between two counterparties. You cannot have a short side unless you have a long side. So if you ask me at any given point in time, how much of the market is short puts? 50%? 50%, because somebody has to be long the other side. There's somebody on the other side, right? That's how the contract works. It's between a buyer and a seller. So if you have 10 contracts and you say how many people are short, half of them. You have 10 contracts, 10 people are short, 10 people are long, because you have 20 participants. So I don't know, you know, when we're saying less sellers, now you could mean that more of the transactions happened on the offer than on the bid. If the transaction happens on the bid, that's a seller initiating the contract. If the transaction happens on the offer, that's the buyer initiating the contract, because they're hitting the offer. Okay. You have less sellers than buyers because the world is continuously long equities. If you're so yeah, well, more people. Okay, so yeah, more people would buy protection than sell. I can understand that, and people like owning insurance. Yeah, this structurally creates an excess of natural buyers for equity puts. Because of this, would this create arbitrage? Well, it doesn't create arbitrage, it creates skew. And depending on skew, it creates the opportunity to sell premium. So if you had equal supply and demand, your implied volatility across all strike prices would be the same. As you get more and more buyers of puts, the implied volatility on puts starts to increase, right? So that when the implied volatility increases, you could say, you know, on a volatility basis, historical versus implied, these are overpriced. So these are nice to sell in terms of selling the volatility that is in that. So it gives you skew. I don't know that you can call it arbitrage. I don't know that you could take advantage of it as a retail investor, only because your transaction cost would eliminate anything you can get out of it. Small but interesting question. It'd be like a blitz format. Is asset allocation more important than stock selection? Yes, it is. 100%. Being in the right asset class at the right time is far more important than being in the right stock at the right time. For a strategic allocation, not if you're like a short-term trader, then it's all about security selection. But over like a 10-year or 15-year horizon, being in the right asset class at the right time is far more important. Diversified portfolio or concentrated bets? Depends. Diversified portfolio, unless you have super high conviction, then it's a concentrated bet, which is good for which type of investor, even in general. In general, be diversified. You know, hold SPY or some index. You're going to get the market. You'll always perform with the market. You will beat 80% of all active managers. You'll be 80 every year. You'll be 80% of all active managers if you just long the market. And when you got a high conviction bet, you size it larger for very high conviction bets. Why some popular and famous investors are saying that modern portfolio theory is shit. I don't know if they're using the word shit. It's old for nowadays. Well, because first of all, it's built on a mountain of assumptions. It's built on a whole mountain of assumptions. You have to have an assumption about the expected return. You have to have assumption about the volatility. You have to have assumption about correlations. Well, that's a guess. This could be informed from history, but you don't know if it's going to be the same going forward. Same with correlations. It's a mountain of guesses. It's a mountain of guesses to get to an allocation which has the highest expected Sharpe ratio, which would be on the efficient frontier. It's all theoretical. It's all based on just a mountain of guesses. That's all it is. So if everything is based on a mountain of guesses, if your guesses is off as just a little, you'd get a completely different portfolio. So if that's the case, why not just pick the stocks you want and be done with it? So yeah, sticking too closely to the textbook is probably bullshit. What the textbook is for is it gives you a model, a way to think about how you would structure a portfolio, but certainly not a blueprint for it. You know, the idea behind finding, as low a correlation between the stocks you're holding as possible. Yeah, that makes a lot of sense. Being in asset classes you think have higher expected returns, well, of course, that makes a lot of sense, right? But everything is a mountain of guesses in finance. The whole future is a guess in finance. Anytime you're predicting tomorrow is nothing but a guess. Educated guess, an experienced guess, an intuitive guess, but still just a guess. And you're gonna be wrong, period. No one in the history of this game has a 100% track record. Nobody. You're gonna be wrong. And at least once a year, you're gonna be spectacularly wrong. Trust me on that. You will be spectacularly wrong and you'll feel like an idiot at least once a year, if not more. For whom is it better to be a growth investor and for whom is it better to be a value investor? Well, for whom is it better to date a blonde and for whom is it better to date a brunette? Depends on your personal tastes, right? Do you like short people, tall people, funny people, serious people? Depends on your taste. It's nothing better or worse than anything else. It depends on what you want. So it's not that it's better for you. What's better for you? That all starts with your risk tolerance. How tolerant are you towards risk? If you're not very tolerant towards risk, then growth will just give you a headache and stress you out every single day. Oh, you'll be happy, then you'll be sad. Then you'll be happy, then you'll be sad. So it comes down to what's right for you, not some broad statements as, oh, everyone should be in growth up to age 40 and then they should be in value. At those broad statements, while being probabilistically on the truer side, is never deterministically true. Are you a follower of efficient market hypotheses? Sometimes, yes. When we say efficient, we don't mean correct. It doesn't mean the price is correct. It just means the price is efficient, meaning if there's news out there, it's already in the price. That means it's efficient. The market is efficient, but that does not mean it is correct. We keep thinking efficient markets are correct markets. Efficient markets just means that you can't do better based on information that's already out there because it's already reflected in the price. You would have to know something that nobody knows. But even the most purest form of efficient market hypothesis says not even private information can give you an advantage. That's how efficient markets are. I don't believe that. I don't believe all markets are efficient. Come down to Costa Rica. It's an extremely efficient market, not stock market, but just the market for businesses and services, and it's extremely inefficient market. So for somebody who is ambitious and efficient in the way they do things, there's a bunch of businesses in Costa Rica that you could probably start and own the country because it is so inefficient. Okay, there we go. When do you plan to post a telecom video? Already up. USD has strengthened about 33% against INR since 2014. If one USD used to cost about 60, but today takes about 80, that means the US has become more expensive. Correct. I thought it was interesting. Year-over-year advanced retail sales is negative for January. Seems like another recession indicator. Wouldn't you agree? Would you agree? Oh, well, the last retail sales, I think a couple of weeks ago, I put it in the market outlook, and I circled all the negative numbers, and I said, there's no good way to look at this one. This was an ugly report, period. It was just an ugly report. But even in bull markets, you get ugly retail sales reports. It is, you know, I'll repeat, you know, what Jerome Powell says all the time. One data point isn't enough. We need to see a trend. We need to see it, over a period of time. So 1 or 2 months of data is not going to be enough. On that, I think you'd have to be more data dependent. One is not enough. Not only that, when you get the next report, there could be a whole bunch of revisions that revise all of that away. So I don't know that I would call it an indicator, I call it concerning. How reliable do you think is the forward earnings guidance? Well, as reliable as any guess about the future can be. What is probably more reliable than any one individual forecast is the average of the consensus forecasts. So, you take a whole bunch of bottom-up estimates and you take the average for each stock of all the analysts who provide estimates. You take the average, probably is closer to what to expect than not. Beginner, I found the quick look at the Indian ETF informative. Good to know what fund details to pay attention to. You mentioned copper again. Appreciate an update on your thoughts on Freeport and other exposure. Well, look at the price of copper. It's not going to breach 360. Usually in slower markets, it'll be under $3. It hasn't breached 360, which tells me when strength returns to the copper market, you're going to break above 4, you even break above 5, a record. I think that sometime in the next 10 years, you might even see $6 copper. It isn't going along for the ride right now, but it is not dropping. Another safe play that I've seen over the last year is selling puts on HG, which is the futures for copper, selling puts at 360. Any thoughts on BlackRock naming ESG investing to transition investing? Well, the transition, from what I can understand of it, I don't want to say an energy play, even though it is an energy play. It's the transition from carbon-based fuels to renewable fuels, which is the E in ESG. And I've always said with ESG, the G is not controversial. We want G. We want good governance. With good governance, you wouldn't have had Enron, you wouldn't have had FTX, you wouldn't have had all of this bullshit with good governance. I want good governance. No one is going to disagree with good governance, period. So it should be ES. The G, we've always had the G, and it's not controversial. The E, okay, maybe not dump sulfur in the air. I can't breathe sulfur, you can't breathe sulfur, so if you're a chemical company and you're dumping sulfur into the air or to the river, maybe not do that. Maybe not drop mercury into the water. Maybe not do that. Maybe go easy with the lead that you're dropping into the environment as well. So I'm okay with that. If you can create energy more efficiently from the sun than you can from fossil fuel, great, do it. I'm all for that. So the E is debatable, but it's not that controversial. If you can use less water in your process, then do it, right? I don't think anyone would disagree with that. It's the S. It's the S that has created all of the problems, because whose S is it? Is it my S or is it your S? Because I have a different idea of what society should be, and maybe we should have my version of it. What makes you right and me wrong, right? It's the S that was the big problem. The G is shouldn't even be there. The G is just as common as anything else. The E, okay, if you can produce a lot more energy at the same or a lower price than other forms of energy, And if we can have battery storage that makes the unreliability of wind and solar more reliable, and we can preserve the environment, because there are environmental impacts. If you can preserve the environment, then go for it. There'll be a market for it, go for it. But when you start imposing your S upon me, I've got a big problem. So I think it's a good move. I think more and more people are finally seeing that a lot of this S that we got to, a lot of this woke S that we got to was just a pile of bullshit. And it's going away, which is very thankful. What's your take on the big difference between GDP growth number and the consumption growth in India? Most of this 8.4 was due to government spending, and it was a big build-out. Increase of 33% year over year, but depends on what they're spending it on. If you're spending it on a safe supply of drugs for drug addicts like Canada is, I'm not making that up, by the way, but if that's what you're spending government money on, then yeah, then that's just bullshit. But if you're spending it on infrastructure, well, then that's good. Same with a trade deficit. If you have a country with a trade deficit, but they're importing capital goods and not consumer goods, that's actually good. My understanding from the spending was that it was mostly capital expenditure, not social expenditure, but capital expenditure. That's good. You want to see that. So I don't know enough about the report itself to dive into the details, but I would say look to that. U.S. market's very sophisticated, so market participants can immunize positions and be interest rate insensitive. When Fed explicitly says we will raise rates, who would want to slaughter themselves and take duration exposure in exchange for some floating rate position? In other words, who would take fixed rate swap and give up floating rate swap? Every asset on a balance sheet has a liability somewhere else. So I'm a bank and I give you a floating rate loan and interest rates are going up. As far as the bank goes, yay. As far as the consumer goes, there's your contract right there. One person needs protection versus another one. So let's say the bank decides that, okay, we're going to put a loan out and we want to have a fixed rate on the loan, and these are floating rate loans, and the consumer wants it. There's your contract. So for everybody who has an asset, somebody else has a liability, and both of them would like to hedge their position. So it's not a matter of it's all one-sided. Keep in mind, a balance sheet has two sides, asset side and liability side. There are a bunch of people over here and there are a bunch of people over here, right? So for the most part, they can, they're both motivated by the same thing. Fed purchases securities from banks with the objective to provide reserves. Who initiates this trade? Well, the Fed would. Either the banks or the Fed goes and does what they want to do. Well, the Fed would determine, the Fed manages the level of reserves. Banks may borrow reserves from the Fed when they want. Well, they borrow reserves from each other. And if they can't, then they can go to the discount window. But whose initiative to trade securities? It's the Fed. That is a monetary policy tool. Name a single day in history stocks have gone down. Yesterday. That was easy. I don't know. Was that a serious question? Name a single day in history stocks have gone down. Yesterday. I mean, okay. INR is not going to appreciate. It'll be around 80. Developing country will continue to appreciate against dollar. Okay, well, different. No matter what you believe, there'll be somebody who believes something else. That's what makes a market. Indian GDP growth was due to government spending. Consumer growth was only 3.4. Only. That's pretty big. Difference between GDP. That's way more than the U.S. That's way more than China, by the way, for the consumer. Way more. Difference between GDP and consumer growth, Should not be more than 0.5%. Depends. For a developed country, okay. For a developing country that has to invest in infrastructure to attract foreign direct investment, no way. No way. I don't know that I would live with those kind of rules. And I think that takes us to the end of it. There we go.